There's 4 ways to invest for beginners that are super simple and easy. The best part, they all work real well. And each one is easier and simpler than the next. Hey there, Money Jim here, your money pal. Kicking us off is exchange traded funds, or ETFs for short. ETFs are one of the most popular investments around, and for good reason. There's an ETF for almost anything you want to invest in. Plenty are super cheap, and you can buy them and sell them at the touch of a button. Unlike picking stocks, ETFs invest in hundreds, sometimes even thousands of different companies, bonds, and other types of investments, making them a super easy way to get plenty diversification. That's spreading the risk around so you ain't putting all your eggs in one basket. Now, even though you can invest in nearly any industry, part of the world, or investment type with ETFs, if you're a beginner investor, you're best keeping it simple. And you can keep it as simple as it gets with something like an S&P 500 ETF. Investing in the 500 or so biggest companies on the US stock market, or a total stock market ETF, which give you some mid-sized and smaller companies too. Either way, you'll invest in hundreds and hundreds of US stocks. Now, if you ain't from the United States, or you want to go beyond its borders, you probably want to invest in more than just US stocks. And maybe you don't want to invest only in stocks neither. Well, you can still do that with just 1 or 2 more ETFs, like an international or global stocks ETF. Maybe a bond market one if you want to ease up on risk. Now, the US makes up about 2/3 of the global stock market. So as an example, if you want to invest 3/4 in stocks, 1/4 in bonds, you could do something like 50% total stock market, 25% international stocks, 25% bond ETF. There you have your very own investment portfolio, nice and diversified and super low cost. You can find all 3 of those ETFs with State Street, Vanguard, BlackRock, or Schwab for just 0.03%. And all you gotta do is rebalance once or twice a year. Now, that's just an example, not advice. So even though you're still a beginner, make sure you do your own research before making any investment decisions. If you still want plenty diversification, but want to go even more simple than a 3 ETF portfolio, you go for an all-in-one index fund. See, they invest in stocks and bonds and maybe some other stuff too, like real estate or gold, all wrapped up in one place. So with an all-in-one index fund, you ain't betting the farm on a single investment or area. And you can invest in them at pretty low cost too, with plenty under 0.2% annual fees. That's more than a lot of ETFs. You pay a bit extra for the convenience. Higher risk ones with more in stocks normally called something like growth or aggressive, while lower risk ones with more in bonds usually called conservative or cautious. Ones with balanced or moderate in the name are your middle-of-the-road options. Is the rebalancing all taken care of for you? All-in-one index funds can be a real convenient option if you want to set and forget and don't want to go all in stocks. Next up, we got target date funds. These are a type of all-in-one index fund, but with a real big difference. They adjust automatically how much you got in stocks and bonds the closer you reach a target date, usually retirement. Though plenty of folks think they'll stick to high-risk investment forever, take from me, you probably won't. I've advised hundreds of folks either approaching retirement or in retirement already. And let me tell you, most of them want to take plenty risk off the table. Target date funds do just that, and on autopilot, so you don't have to lift a finger or even think about it. In theory, you could invest in nothing more than one of these your whole life, and it would do just fine. Here's an example of how they work. See how the closer you get to the target date, the amount in stocks goes down and the amount in bonds goes up. Thinking behind it goes, you make most of your growth early on by taking high risks, and later on in life, you switch the focus to keeping those gains rather than chasing more but potentially losing a bunch. Again, you could invest in target date funds at a real low cost, with Vanguard's target retirement funds coming in at just 0.08% and BlackRock's LifePath index funds at 0.09%. And last up, perhaps the most simple of them all, we got robo-advisors. Robo-advisors use algorithms to build and manage your investment portfolio based on your stomach for risk, financial goals, and how long you invest them for. So you don't even have to choose any investments or manage them whatsoever. Popular robo-advisors include Acorns, Betterment, and Vanguard Digital Advisor, but there's plenty more out there. How robo-advisors work is you answer a few questions, send them your money, and they do the rest. Most automatically rebalance your portfolio, and some even optimize for taxes. Plenty got fees as low as a few bucks a month, and they generally invest in ETFs, keeping overall costs down as well. So if you're just starting out investing, robo-advisors could be the simplest, easiest option for you. If you want to find out how much you really need invested to retire, click on this video right here.